You're listening to the ZABE Smart Mortgage Podcast, a podcast show that inspires and educates you about the lending process, what trends we're seeing, how to get the best rate, and so much more. Hosted by Fidel Dorado, team leader for the Fidel Dorado team at ZABE Mortgage Group. Fidel has helped hundreds of people with their mortgages, and now he wants to help you become mortgage smart.
Hey everyone, welcome back to the ZABE Smart Mortgage Podcast. I have Jeremy here with Essent PMI, and we've been talking about ways that we can use PMI, what PMI is, how does it benefit you, why it's needed, and how it can help you purchase sooner. And we've also talked about the 4 different options that PMI that you can pay for PMI and how you can go about either eliminate it and things like that. So, and that's how we're going to finish it off today, right? As far as what is the way to get rid of PMI? How can I get rid of PMI? When can I do it? Is there certain procedures that I have to do and all that good stuff? So, Jeremy, welcome. Thank you. And let's get that information out there.
Thanks, Fidel. There is a couple of different ways to get rid of it. The first is the Homeowners Protection Act, and it's a federal law that says when the loan to value reaches 78% on the amortization schedule based on the origination purchase price or appraised value, the lender has to inform the private mortgage insurance company that it has reached 78% and that it is time to remove the mortgage insurance. And this is related to monthly mortgage insurance and doesn't apply to single premiums. There's a few other kind of things, has to have a good pay history, and there's a few other kind of caveats, but in a nutshell, that's the first way. And then the second way is borrower initiated, and that can happen at 80% loan to value based on the origination value or purchase price, whichever is lower. And that's when the borrower reaches out to the lender and says, hey, I think we're at 80% loan to value.
So the first one is where it reaches 78%. That happens automatically, right? Where it doesn't have to be initiated by the buyer. That just happens as soon as it hits 70% of what they acquired the property for. Is that correct? What they acquired it for?
Exactly. The purchase price or appraised value, whichever is lower.
Got it. And as far as the borrower initiated removal, can that happen? Let's say, for example, if somebody has paid down their principal balance, let's say within 3, 4, 5 years. Is that a possibility? Is there any minimum requirements and minimum time frame that they have to have mortgage insurance on there for?
Yeah, that's a great question. We get that a lot. And from the perspective of the private mortgage insurance company, there is no minimum time that the servicer has to have that insurance in place. Sometimes the servicer will say that the borrower needs to be paying on time and be in this loan for a period of 2 years. And I've heard 5 years sometimes. And that's an overlay placed on the loan related to mortgage insurance by the lender, but not necessarily the mortgage insurance company. And yes, again, it's up to the servicer. But if they're paying down their principal and it reaches 80% faster, yes, of course they can reach out to their lender and talk about having it removed. And some lenders will actually talk to folks about current value, right? So there's 2 different ones. There's the purchase price value, and then there's current value, and they're not the same. And some servicers will allow that conversation, and maybe the borrower can provide an appraisal, and if that servicer decides they want to have it removed at that time based on the information provided, then they can do that.
Got it. So basically there is a difference. There's a difference between, again, just going back so everybody can fully understand, is that it will automatically fall off when it reaches 78%, automatically, without it being initiated. So the buyer doesn't have to, or the homeowner doesn't have to pick up the phone and call the lender or the servicing lender and say, hey, can you please remove the mortgage? That will automatically be done. Now, if it's prior to that, right, now there is the borrower initiated removal where if they reached 80%, then they can pick up the phone, reach out to the lender and say, hey, we need to, I'm at 80% now from what I acquired the property for. Can you please remove the PMI? Now, are they obligated to do that at that time, or is it still up to the servicing lender at that time?
Yeah, I mean the borrower is not. I mean, oftentimes the borrower just won't know, right? But no, there's no obligation for them to do that. Of course, they would, if they would like to have it removed at the appropriate time, um, and it would, help from their lending professionals like you. They could probably figure out, in the beginning of the transaction, like when that would happen, when what the principal balance would be at 80% LTV.
Gotcha. So, and they could even look at that if they request for an amortization schedule from their loan officer, from the
Mm-hmm.
lender, that it'll show them what the percentage, what the balance needs to be in order for them to reach that 80%, and they could start that bar initiated. Now, going back to again, bar initiated is if it's been a couple of years, and again, just to clarify so that everybody could understand. And let's say
Mm-hmm.
their value has appreciated, or they did a large principal pay down of the balance, right? Principal payment. At that point, they can also request for it, bar initiated request for it, contact the lender and see if they can get it removed at that moment, right? So two parts of it, I guess. One is paying down the principal balance, right? Reaching the 80%, requesting for it to be removed at the original acquisition price. And then there is the combination of either paying it down and then the appreciation of value, and hopefully that the lender can, will accept for maybe a homeowner paid appraisal to be done to justify the value, to prove the value, and then for them to actually approve the removal, right? So those are the different options that they may have.
Exactly, and it varies from servicer to servicer on kind of the flexibility of it all, and if they want to use current value or the origination value. So it's also important to stay in contact with your servicer and know what kind of their flexibility rules are, I guess.
Gotcha. You know what, Jeremy, I just remembered about an example, a story that we talked about last time too, as far as 20% down. I had a client that, and we were talking about benefits, and we talked about benefits about PMI and things like that, of how it can help a homeowner. But
Mm-hmm.
one of the benefits also is that, and now it doesn't happen in every single case, but with this particular case, it did happen this way, is that when I ran the file through, the client had 20% down. He had it, so everything was good without the PMI. I priced it out, and the rate, for example, I'm just going to use an example right now. It was like at 5.25, right, with 20% down. For some reason, I ran it at 19% instead of the 20%. I ran it at the 19%, and the interest rate was actually an eighth of a point lower at 5% versus 5.125, whatever it was, but it was an eighth of a point lower than what it was with 20% down. So now they were going to have the PMI for that 1 year, year and a half, or whatever it is. And I think the PMI was only going to be like $19 or $20 per month for that 1 year, year and a half. But we were able to leave PMI on there and do it at 19% instead of 20% now. And I was able to get them an eighth of a point better in interest rate. So if you look at the savings over the long run, I mean, that was a big benefit to the client. And just by, again, PMI, it's not always bad. It could always help one way or another. Again, because of that protection that the lender is receiving, they might incentivize that with the interest rate. Am I right?
Oh yeah, 100%. We call it the power of five. It's keeping that, like your case, your example wasn't 5%, but you could do it with 5%, and keeping that extra 5% in your pocket to be used to buy mortgage insurance or to do improvements. It could be a big chunk of change, and the benefit in terms of the note is, yes, with the mortgage insurance, the loan level pricing adjustments fall in the favor of the borrower by just the fact that there is mortgage insurance on that loan, the pricing gets a little bit better. So it really works out a lot of times. And then, of course, you look at the monthly or compared to a single, figure out where it's going to be on the amortization schedule to hit that 78% or that 80%. And then you could just kind of do the return on investment math to see which premium plan is better. Is this, in your case, it was probably the monthly because it was only a year as opposed to a single. Whichever way it works out, that's the premium plan you go with. So yeah, it's a great tool, and not a lot of people know about that. So kudos to you for figuring it out and knowing it and serving your borrowers.
It doesn't always work. I mean, it just depends on the pricing, right? So, I mean, but it doesn't hurt to try either. So I just run a bunch of different scenarios and see what's going to benefit our buyers. I mean, 19%, 15%, Are we going to do the full 20? Whatever it is. I mean, at the end of the day, it's about just leaving no stone unturned and presenting all those different options and explaining why, not just the what. Well, this is what you should do, but why you should do it and the story behind it and stuff like that, so they can make a more informed and a smart decision. So now the other thing, and again, I wanted to bring that up because it just popped into my head when I was thinking about eliminating the mortgage insurance, and somebody that did have the 20% down, they're like, I just don't want it. I just don't want it. I'm like, well, if we look at this strategy, do you mind paying $20 to save anything of a point on your interest for the remaining 29 years or whatever it may be? So yeah, so sometimes, like I said, it's a good strategy with that kind of stuff. So let's talk about some of the other benefits that PMI may have and one of them is it tax deductible?
Yes, it was extended and still is still tax deductible, but I'm not going to, basically should talk to your tax professional about it. But yes, there was some legislation that kept that in place. But definitely talk to a tax person and look for the benefits of that.
Helps you get into PMI, helps you get into a home sooner, right? You can utilize your money that we're considering as far as putting down, whether it be 20 or 15. You can maybe use it in a better way, maybe just doing a single premium, split premium, or whatever it may be, instead of putting that big sizable down payment. So there's different ways that you can use that down payment to benefit you. We just talked about right now how it helps somebody get a lower interest rate as well. An eighth of a point, any kind of a savings is a good savings in my opinion. So and then of course the potential for it to be tax deductible. Of course, check with your tax professional about that and see how that benefits you and if it benefits you. So those are some of the stuff. Anything else that you want to throw out there that is a benefit or that you want to highlight?
No, I mean, I think we covered it all. I think knowing how to use mortgage insurance premium plans is huge for lenders, because it can really help their borrowers, of course, get in with as little as 3% down. But like you said, there can be some other benefits to, I mean, if it's a $500,000 purchase, that's $25,000 in your pocket, right? So there's a lot of things you could do with that money. So it's really about, the fun part about my job is talking to folks like you and kind of expanding their horizons on how to use premium plans and some of the strategies on how to benefit their borrowers in multiple different ways, using MI. So you pretty much covered it, and I'm glad you did. You did a great job on it.
Thank you. We got to get this stuff out there so that people can be more informed, make smarter decisions, bring more value, whether it be to our potential buyers, clients, realtor partners, other lenders that are out there. We just need to bring a lot more knowledge to our industry to better serve our clients. And I think that's really the goal of what we're trying to accomplish here. And I'm hoping that we're doing that with some of the information that we're putting out there. So what can we find you, Jeremy? Well, what's the information? What can you do out there for our fellow loan officers? Where can clients go visit your site and maybe even do some videos that they need to watch so they can learn? And again, going back to with other lenders, where can they find you? What can you do for them to learn and become better?
Yeah, well, there's a lot of great tools. Obviously, they can contact me and we could run through scenarios and hash out some loan details. But on our website, I mentioned it before, it's essent.us, and on that website you can find the Rate Finder tool, where you can compare 5 different premium plans and one including FHA. It's a great tool to help your borrowers. And then Essent IQ, which is also on that website, and that's kind of like the, should I buy now or wait? And it's a calculator basically that really illustrates the benefit of buying now with private mortgage insurance as opposed to continuing to save and rent. And then we have some really great training that I know you've utilized for some of your new team members and loan officers on our website, essent.us. There's great canned trainings, there's scheduled trainings, a lot of self-paced stuff on sales skills in the mortgage industry, calculating income, stuff for self-employed borrowers and all the variations that it comes in. There's a lot of great tools there, and it's free. You don't need a login, and it's easily accessible.
Awesome. Are you going back to doing some live training as well, or that's coming down the road, or how's that going?
Well, I'm glad that you brought that up. We are are doing some live trainings now. In fact, with Golden Empire Mortgage, it's not live, but every month we've been doing a half hour, 30 or a 35-minute, 40-minute session for all of your operations folks and loan officers alike. Anyone who wants to join with the training crew, they can come and watch our webinar. Rental income or analyzing K1s and things like that. We are doing some live stuff, but I am doing some live stuff. I've come into your office before to talk about premium plans. So I'm on the streets and I'm out, talking to folks face to face and teaching them about how to use mortgage insurance properly.
Awesome. Well, thank you, Jeremy. I appreciate you taking the time joining me today. I know, like I mentioned, it's a lot of information that's out there about mortgage insurance that people can be confused about. Us in the industry, loan officers, realtor partners, especially our potential buyers and stuff like that. And so I appreciate you coming on and really sharing your this information, your knowledge, and different ideas of how PMI is a good thing and how it can benefit us and how it can help buyers accomplish, achieve home ownership a lot sooner than what they were hoping for. So I appreciate you, Jeremy. Thanks, man.
This has been an episode of the ZABE Smart Mortgage Podcast. Whether you're a first-time home buyer, purchasing your next home, or refinancing, being smart about your mortgage options will save you time and money. ZABE Mortgage Group connects you to the technology, resources, and education to make you mortgage smart. From pre-approval to applying to getting approved and managing your loan, visit zabemortgage.com.